and his team over at UPSA for giving me this opportunity. And it's something I've been looking forward to over the last few months. So back to your question, Ernest, the banking sector couldn't have been more resilient than it is now, at least compared to the pre-reform era. And I think the Bank of Ghana has been very transparent about the fact that post-reforms, post-cleanup, if you want to call it that way, the banking sector has proved itself to be very resilient, even in the face of this pandemic. So you talked specifically about liquidity, which is of course one key measure of bank performance. But even across all the other key measures would usually gauge, which would be the asset quality of banks, it would be their profitability, and as measured by various ratios and all of that. The banks are indeed much stronger than they were before the cleanup. The sector now has 23 banks, down from about 34 or so when the reform started. And these 23 are stronger. They're well capitalized, they're liquid, and they're profitable. And so even in the face of this pandemic, we're seeing that the banks are standing very strong and have actually been a key player in helping to stabilize our economy. And so that's really good news.
That's indeed good news to know that our sector is resilient. Mr. Ado, I don't know whether you want to add something here concerning the general overview of the banking sector and the liquidity in the banking sector. Now, I'm sure you are well placed to also give us a view on that, knowing that you are in charge of several of the fallouts from the crisis. Hello, Mr. Ado. Hello, Mr. Ado. Okay, so I'll come back to Mr. Ado later, but let me come back to you, madam. Yes, I want to find out what's the state of toxicity in terms of the banking sector. When I looked at the topic toxic asset, I'm sure people will be wondering what is toxic. Maybe you can start with what toxic asset is as general, and then let us know, what's the state of the toxic? Are banks still trading in toxic assets? Are they taking such securities, or it has reduced? Maybe you can give us some overview on that. Thank you.
Okay, thank you, Ernest. Let me start by explaining what banks' balance sheets look like, and then we can get to what you mean by toxic assets. I hope by that people don't think you're referring to weapons of mass destruction and other such items. But typically, a bank is licensed, right, to collect deposits from the public. Very simply put. So the Bank of Ghana would license a bank, Bank A, to accept deposits from Tom, Dick, and Harry, and to promise everyone who brings their deposit that they would return the deposit to them on the terms agreed, either with interest or not, by a given time or on demand. So basically, that's what banks are licensed to do. So we call this process essentially the process of intermediation. Banks accepting deposits and then creating assets out of these deposits. So what happens is that when a bank takes your money, that money you have given the bank is reflected as a liability on the bank's balance sheet. Okay, so if you know anything about balance sheets, that's on the liability side of the bank's balance sheet. The bank is promising to pay you back. So you have lent money to the bank. Now, for the bank to be able to return your money to you, so and hopefully also make a profit on the money you give to it, the bank is going to have to invest the money in something, and it will typically be in loans. That's what the process of intermediation is about. So the bank takes your money and creates loans out of them. So another person comes to the bank to say, I need a loan to buy a car, I need a loan to buy a house, I need a loan to start a business, and the bank creates a loan out of the pool of deposits that it holds on its balance sheets, right? Sometimes the bank would also invest in treasury bills, in other fixed income assets and all of that. But basically, the bank is expected to invest the deposits you have made with it in a manner that allows it to be able to pay you back when you go back for your money. Now, banks are regulated in a way that ensures that a portion of every deposit you give them is set aside as a reserve, as a cash reserve. In Ghana, we have a 10% cash reserve requirement, so that for every 10 cedis you give to a bank, 1 cedi of it is kept somewhere with us as a liquidity reserve, so that they are able to lend or create other assets out of the 9 cedis. Now, it is essential that these banks then manage the 9 cedis, or the 90% of the deposits they've taken, so that at every point in time, they are able to liquidate those assets and pay back their liabilities to their depositors. Now, the issue of toxic assets comes in, or the phenomenon of toxic assets come in when a bank has either lent these sums of monies it's collected from depositors to persons that never pay back, for example. And so these becoming non-performing loans. The loans do not perform according to the contracts under which they were provided, or that they have invested these amounts in other investments, of course, that they are not able to recover from. So this is the concept of toxic assets. Ideally, banks must hold assets, like I said, that are readily available to be able to pay off their liabilities. Not all of these have to be in the form of liquid assets. So they will typically have a combination of liquid assets as well as fixed assets. But by a combination of all of these, the bank should have enough liquidity to be able to pay off their liabilities as and when they fall due. When you have banks either not exercising the proper due diligence before they grant loans, or banks grant loans to cronies or affiliated companies and others of shareholders, and so are not able to retrieve those funds, or sometimes borrowers just don't pay their loans, right? But this is actually a function also of the credit underwriting process, so that the banks are more assured than not that a borrower would pay back their money. So all of these lead to a situation where the bank has put their money in assets that are irrecoverable, at least at the pace at which they're getting demands for withdrawals. And that's what we call toxic assets. So back to your question as to where we stand in the industry in terms of toxic assets, the simple answer is that the quality of bank assets in Ghana has improved considerably compared to the pre-cleanup era. So you may have heard the Bank of Ghana say from time to time, for example, that the non-performing loan ratio, which is a ratio of loans that are not performing to the entire loan portfolio, has trended downwards over the last 2.5 years. And that's true. You realize that a lot of the banks that we closed, we had to resolve, were stuck with non-performing loans, most of which had been given to the affiliate companies created by the shareholders themselves. So those loans were never expected to be paid back. But that came at the expense of depositors, because depositors' funds were used to create those loans. And to the extent that those loans were not being repaid, depositors then were left with straw in their hands. So basically, we have seen a consistent improvement in the asset quality of banks. There are still non-performing assets, but you're comparing a non-performing loan ratio of about 15% as of November 2020 to 20%, for example, as of December 2018. And so consistently, we're seeing an improvement in banks' asset quality. And this is thanks to our new emphasis, our new focus on stronger corporate governance within the banking sector, so that the boards and the key management personnel that are approved by us to run these banks are doing a better job at risk management. And so that is part of why we're seeing an improvement in asset quality. So the era of toxic assets, I would say, is not, when banks would always have some bad assets, but ideally you want that to be as little as possible in terms of the overall asset base.
Thank you very much, Madam. Mr. Phyllis Addo, you're welcome. I invited you earlier. I understand your network was playing up. Welcome again.
Thank you very much.
You're welcome. By way of introduction, I'm sure you are so exposed to the industry and you have worked on a lot of banks who were sick and or who have even died. Now, from your experience and from your perspective, comparing the former state of affairs and the current state of affairs, will you say that our industry is resilient enough to withstand pressures that may come up, especially in the era of COVID-19? Thank you.
Yeah, thanks, Ernest. Okay. I'm sure the Deputy Governor has explained how resilient the banking sector is. But from an outsider looking in, I can assure you that the Bank of Ghana took some immediate steps with the advent of the COVID-19, which even made our systems even stronger. Okay, I recall that about a year ago, the bank stopped dividend payouts. It also reduced the buffer, the capital adequacy buffer, from 13 to about 11.5%. Okay, now this went in to help us withstand the COVID stress. Okay, the Bank of Ghana also, in its COVID-19 provisions, allow banks to use to reduce their loan categories, the reserve categories, from about 10 to 5%. Okay, which all went in to beef up our resilience. Okay, so I can say that in the last 2 years, in fact, if we haven't had the sanitization, if I could describe it that way, of the banking sector, we wouldn't have standing the chance in trying to get where we are today. And that is why today we still have banks which are performing, they're making profits, and the shareholders and depositors' monies are not at risk as they were about 2-3 years ago.
Thank you. Thank you very much, Mr. Addo. Thank you. I think it's refreshing to know from an outsider's perspective the state of our affairs, and it's encouraging to hear that from you. Thank you. Now let's look at Madam Awadi. Let me ask this question before we go to the insolvency issues and matters of that nature. Looking at the state of affairs and where we came from, has the Bank of Ghana conducted any stress test recently? And if so, what was the result? What's the health of our balance sheets in the industry?
Okay, thank you, Ernest. So as a matter of course, one of the regulatory tools we use is to conduct frequent stress tests of the banking sector. And we do this on a monthly basis, actually. So what we do in a stress test is to say that we know the banks are fine, the balance sheets look good for today, but what we do is try to project various scenarios under which the banks could be under stress. So we'd say, well, if this happened and that happened, how are the banks well positioned to deal with those shocks? So we'll typically sort of stress banks under, we'll put them under, fictionally, we'll put them under stress conditions. For example, if there's an interest rate shock, if interest rates were to reduce overnight drastically, what would that mean to the interest income that banks rely on? If exchange rates were to move overnight, by a certain margin, what would that mean to the bank's foreign exchange-based loans they have provided? Will their customers be able to pay? If the banks all of a sudden suffered a liquidity stress where a lot of their customers want their money now, how will the banks do? So we stress them, we stress their P&L and balance sheets under these conditions. And then we would say, in these mild or moderate or severe conditions, how are the banks able to do it? Do they have enough buffers of capital? The idea of stress testing is that you want to ensure that under the stress conditions that you project, the banks are positioned in terms of having capital to be able to deal with those, to weather those storms. Because capital is really the key way in which a bank is able to withstand risks that it faces. So basically, we do this on a monthly basis, and the last stress tests we did, we'll be disclosing them next month. We announce this every time as part of our MPC process. MPC stands for the Monetary Policy Committee of the Bank of Ghana, that meets every other month. So every other month, you must see the governor read a statement about the state of our economy. And then he would also share what our latest stress test would say. But the last one we made public was as of November 2020. And we said then that the banks were resilient under all the stress test conditions we had put them under. So short, your question is yes, we do conduct stress tests, and our current stress test results show that the banks are resilient, even in the face of a pandemic, would be resilient under the severest of shocks. But mind you, that is because we had carried out the reforms. This is a point Felix made, I made also earlier. We had carried out the cleanup, and we had asked the banks to recapitalize. And like I said, for a bank, equity capital is a shock absorber. And so the more of that a bank has, the more it's able to withstand shocks.
Thank you so much. Mr. Ado, looking at your background, I know you have been involved in the legal aspects of the banking industry, in the Insolvency Act, and then even the Companies Act reforms and all that. Let me find out from you, is the current legal and regulatory regime adequate to protect the banking industry as a whole and from the contagion of toxic assets as a systemic problem?
Yeah, Ernest, thank you very much. Okay.
You're welcome.
I can say that the systems we have in place now are robust enough to be able to withstand any shocks. Okay. On the banking side, at 9:30, put in place provisions. For example, the introduction of an advisor, the introduction of administration, the appointment of receivers, and on and on. Now, with the complementary law, which was passed last year, that's the Corporate Insolvency and Restructuring Act at 1015, that kind of covered the rest of the business environment, okay? The real economy, so to speak, all right? If you assume that the banking sector or the financial sector is the non-real economy, and then the real economy is those who purchase, who manufacture, who sell goods and the like. That's those who are in production and the like. Now, the SIRA Act takes care of their restructuring needs. Okay. So now the companies, the bank lends monies to, have a way of restructuring themselves if for whatever reason they get distressed. Previously, they would go straight into liquidation. As of now, they don't have to go into liquidation. They could appoint an administrator, just like the Banking Act also allows for. Okay. Now, with the administrator, he or she can reorganize and get the creditors to accept what we call a restructuring plan. Okay. So if they are allowed to restructure their company's activities. And it's not everybody who can be an administrator. You have to be a qualified insolvency practitioner. In other words, you have to know what you are doing, okay? Now, if you can turn around the company, all right, that is one plus for banks which have lent monies to the companies, okay? So previously, the bank lending goes bad, it becomes non-performing. Now, there's a glimmer of hope to turn around the restructuring and then ensure that the company comes back or stands on its feet so as to service the banks and then ensure that the banking lending doesn't go to waste and create toxic assets. Okay.
Thank you very much, Mr. Ado. And so if I understood you well, whereas the Act 1015 gives a regime where the companies or the borrowers from the banks can retune, restructure, and reformulate themselves when they are in crisis. The Banking Act also provides a regime where the banks themselves can also reinvent themselves when they are in some sort of crisis or difficulty.
Absolutely, absolutely. Yeah. And this
Thank
is
you.
interesting because in
Yes.
about 20 years ago, when we first did the liquidation of Bank for Housing, we didn't have specific provisions like administration or receiverships in the then Banking Act. Okay, so the bank goes into distress position. The next alternative is to go into liquidation. Now, the bank is not a tomato factory, so to speak, where you can close it for a few days, and then when you get your act together, you come and open it, and then invite your creditors and your depositors to come and bank with you. If you do that, they will come and clean your bank out. They will take every single peso in the banking institution because you've lost faith, okay? But now, under the law, the two laws, there is a semblance of some orderly process whereby not only the banks, but also companies, we have a fair chance of turning themselves around. Okay.
Thank you. Madam Ado Awadzi, I mean, from the regulators' view, do you see this complementary role as a very helpful creation of the law?
So, well, thank you. I think your original question, which you asked Felix a few moments ago, was also about whether these two pieces of law, the Corporate Insolvency and Restructuring Act and the Banks and Specialized Deposit-Taking Institutions Act, would help to sort of make toxic assets less of a problem. Is that right?
That's correct.
And I think he gave a brilliant answer to that. So let me step back and start from there to say that the banking relationship has got different facets, okay? So there's the regulatory ambit of that, which is what we deal with as regulators. And Act 930, or the Banks and SDIs Act, is what we use to regulate the banks. So that sets out our powers and the expectations that we have of the banks. And then we do have, in addition to that, this plain vanilla contract law that applies to the banking relationship between banks and their customers. When the bank, I talked about the fact that toxic assets are a phenomenon where the bank has put money somewhere and is not able to retrieve it, okay? Or is doing that with some difficulty. So you have contract law that governs that. And then you have a court of law that helps with enforcement, okay, of these contracts. So if there's default on the part of the customer, for example, the bank should go to court. So there are many. I'm making the point that there are many components of the ecosystem that have an impact on the level of toxic assets. Even let's stick with loans. Even with loans, right? You do want the banks to be able to give loans after having done sufficient due diligence, and to make these loans to people who are trustworthy, hopefully with some collateral, so that if the loans go bad, they're able to enforce these collateral and retrieve some value from it. Because mind you, it is really depositors' funds that are at play here. If you look at the typical bank's balance sheet, no amount of shareholders' capital is equal to the amount of deposits they hold. Okay, so really, when people say, well, my bank failed and my bank failed, it's very funny because it is really depositors' banks that have failed. The shareholders usually have very little capital compared to how much deposits they hold. Okay, so the regulatory policy aims at protecting depositors, and by that, the entire financial system. So a lot of components come to play. It's not only these two main laws you've mentioned, it's also a function of how the banks themselves enter into these contracts and the due diligence that they undertake. What we have done as a regulator is to put in place a credit reporting system, which is like a database where all the banks and other lenders put information on their creditors, on their borrowers, I beg your pardon, so that if the borrower consistently pays off their loans and services their loans, that information is available to the database. And every bank, before they make a loan, should check the standing of the of the prospective borrower. Is this a borrower that pays their loans? Where do they stand in terms of their credit scores? And how should we price that loan to take care of the risk that pertains to them as borrower? So we believe that if banks are doing these well, they would end up making less and less irresponsible loans, imprudent loans, I might say, because we want banks to take risks. That's why we give them a license. And banks exist to be able to promote the real sector that Mr. Addo talked about. So we want them to make loans, but we want them to make it with due diligence and taking the necessary safeguards. We also have put in place a collateral registry system that allows banks, when they have granted a loan and taken collateral on an asset of the borrower, to go to this registry to register it, their interest in the collateral. And that law makes provision for banks to recover from these loans and collateral without necessarily having to go to court. Well, under certain circumstances, they still have to end up in court, but that's for another day. But at least that was an attempt by the regulator to create that enabling environment, both on the credit assessment side, through putting in place a credit bureau system where credit information is available to the entire banking system. And then on the recovery side, a collateral registry system that helps somewhat in banks trying to recover their loans. Otherwise, in between these, you're stuck with a court system where banks must ultimately go to try to pull out money that they have lent, sometimes for years, without success. But let's get back to Act 930, which is the Banks Specialized Deposit-Taking Institutions Act, because that deals with how we regulate the banks. And when banks begin to suffer distress, financial distress as a result of high levels of toxic assets, we have tools under the Act to be able to do something. Now, as Felix said, under the Corporate Insolvency and Restructuring Act, the banks now would also have tools in what they do with their customers. So if it's a corporate customer that is not paying their loan, the bank can, for example, start a restructuring process or an insolvency process, can trigger that so that it gets hold of the assets of the customer, for example, and start a process of administration or anything else. On our side, when it comes to the tools available to us as a regulator to deal with a bank in distress, we have a wide range. And ideally, we should deploy those tools very early on, including stop them from paying dividends sometimes, ask them to change their boards or their management if we feel that is part of the problem. We can ask them to sort of stop making new loans until they have recovered sufficiently on existing loans. And we can appoint an advisor whose sole role is to advise the management. The advisor doesn't have the power to take over control over the bank. We call all of these prompt corrective actions, and the law gives us triggers for exercising these powers. But when it gets to a point where the bank's capital is sufficiently deteriorated as a result of these toxic assets, we do have power to take more intrusive action. For example, put the bank under official administration. And by that, the board, the shareholders, and senior management no longer have powers over the bank, and they all must work through the official administrator. And that is to help to assess exactly how bad the situation is and explore if there are any options for restructuring the bank and allowing it to continue. And then ultimately, the law says when the institution has become insolvent, and insolvency is a real possibility when you have high levels of toxic assets that don't get resolved. Ultimately, the law says when the institution becomes insolvent, we must, there's not, we may. And that's one thing people forget. We must then revoke a license, appoint a receiver, and begin a winding down process of the bank. So ultimately, we expect that through strong supervision on our part, we don't get to insolvency, but sometimes that can happen very fast. And that's why post cleanup, we have actually spent a lot of time coming up with new rules, including on corporate governance, so that board and key management personnel are managing these institutions better in a way that are not leading down to too many toxic assets. What had happened before the cleanup was simply a case where shareholders really controlled these banks to serve their empires. So a typical institution would have maybe 40 or so affiliate institutions, all of which are being funded by depositors' money through a bank. And when that happens, these assets never get recovered. So we're through supervision and the new rules we put in place and more stringent monitoring of these banks, we're helping to ensure that these don't happen going forward. But if these happen, we have tools under the Act, as I mentioned already.
Thank you so much, Madam Elsie Awazi. I think if you were in a lecture hall, you have given us a perfect class for today. Ladies and gentlemen, this event has been made possible by the kind courtesy of Upsa Ghana Limited. If you have any question, kindly go to the chat function. Type your questions. In about 10 minutes or less, we will come to the questions that have been asked. And at this stage, I'll ask one question that ties in so well with our earlier discussion. And this is from Miss Yom Ama. Miss Yom Ama, I hope I got the name right. The question is, so if the BOG, the Bank of Ghana, conducts stress tests in all the commercial banks, how come some of the commercial banks were able to become insolvent? What is the relevance of the stress test to commercial banks? I'm sure Madam Ado Awazi will help us on this briefly.
Okay, well, let me try. So, like I said before, stress tests just give us an example of how well capitalized an individual bank is. And so, yes, if a stress test result shows that the bank might come under distress, under certain shocks, it is our duty then to start a conversation with your shareholders to say, you've got to recapitalize, and that conversation we would have. If the situation gets dire and that because the shareholders are not able to recapitalize it, then, like I said, we do have rules under the Act. Now, what had happened before the cleanup was that banks were clearly insolvent. And even beyond the stress test, the Bank of Ghana had undertaken what we call an asset quality review, which is a deeper dive into the assets of the banks to say, let's look at each of these assets that they hold in each category and see how recoverable they are. And the results showed that a lot of banks were insolvent or at least very severely undercapitalized. And then the Bank of Ghana was supposed to have required banks to recapitalize. That process took too long. And so the banks became insolvent and even worse so. And as a result, from August 2017, the Bank of Ghana had to close these banks down. But stress test results will just show you what is likely to happen. And then that should start a round of conversations with the banks with stringent monitoring and very clear actions required of banks to ensure that that event does not happen, or if the shocks materialize, that the banks are able to weather the storm. So it takes strong supervision to get banks to stay on course. Ultimately, sometimes shareholders are not able to provide additional capital, which is required, as stress test results will show. And that's when a decision must be taken whether to close the bank or to do something else with it.
Thank you so much. And this question is from Kweku Owusu, and I'm sure Mr. Ado will be very happy to take this question up for us. Kweku is asking, please, what provision is made for small and medium enterprises for the new Restructuring Act in terms of the cost of restructuring process, where these small and medium enterprises have limited resources? These entities make the bulk of businesses in Ghana. And I'm sure by the Restructuring Act, he means the Corporate Insolvency and Restructuring Act, Act 1015.
Yes, that's a very good question. Now, the Companies Act gives the registrar of companies the opportunity to classify companies into large, medium, small, and then make appropriate regulations, okay, to each of these classifications. Okay. So yes, essentially, the requirements of the Corporate or the Companies Act may seem overwhelming to a small company, but when the companies register, when the office of the Registrar of Companies is established, then we'll have the classifications for the various categories, and I'm sure that there will be provisions to flex some of the requirements. As it is now, though, small, medium enterprises who are registered as companies, we have to face the full brunt of the Companies Act. In other words, if you are not quite at that stage, you don't have to be a fully fledged company, right? Being a company carries a certain level of responsibility, like having annual audit statements, filing returns, and all that. Now, if you are not really ready for that, you can just have a business advisory name, and you can perform at that level. Okay? But once you step into a company registered under the Act, then of course, the full weight of the requirements come into play. All right. But for now, that's where we are. When the Office of the Registrar of Companies is fully established, then there will be some opportunity to flex some of these requirements depending upon the classification. Okay. Now, the classification may be done based upon turnover, may be done based upon employee number, may be done based upon number of years in operation. At this point, the Office of the Registrar has not come up with that yet. Okay. So as they say, watch this space. Very soon, you have some developments in this area.
Thank you so much. Thank you so much, Mr. Ado. And let me ask this question also. It says that has the model of appointing receivers since the collapse or mergers of some banks paid off? Would you say it has paid off, the model in appointing receivers and appointing receivers since the collapse or the mergers? Have they paid off, would you say?
Well, I guess this question probably belongs to the Deputy Governor. But if you ask me, I would say yes, because you need an independent third party to supervise the operations of the bank, of the distressed bank, okay? And the law provides for receivers, okay? Now, under the new Companies Act, receivers are supposed to be qualified insolvency practitioners. So you don't just appoint any chap along the, along the line as your receiver. The person must be qualified in terms of restructuring, in terms of insolvency provisions, okay? So at this point, that's about the best thing going for us. So I would say yes, but let me defer to the governor, the deputy governor, to add to it, yeah.
Yes, if the deputy governor will add this question, what are the specific liability of banks to creditors and depositors upon collapse in insolvency? To that question, I will be grateful so that you tie both questions in for me.
Well, thank you. So I believe your first question was whether the mode of appointment of receivers, right, was
Yes,
beneficial.
yes, yes.
Well, the mode of appointment of receivers is set out by law. So I don't know what that means. It's very it's straightforward. We find a qualified person,
Yes.
aligns
So if
itself
I
out.
may, yeah,
Yeah.
so the mode as set out in the law, do you think is apt or it needs fine-tuning of a sort
So I don't think
in
there's
resolving
anything
the
wrong with the
crisis?
mode. And that's what I'm saying. I mean,
Okay.
are you talking, is the question about the mode of resolving the crisis or the mode of appointing a receiver? Because
The mode
appointing a
of
receiver
appoint,
is easy. That's
yes,
appointed. It's
yes, we've had some challenges, especially the not specifically with the banks alone, but the non-bank financial institutions, and which have had issues with having their monies, their deposits paid back to them, and the issues that have been raised. So is it that we have issues with, is there an issue with the appointment of receivers as the law prescribes, or that's not the issue? Or in terms of resolving the crisis, is the appointment of a receiver an issue in the whole equation?
okay. Let me see if I understand this. So, like I was saying, the how a receiver is appointed is not the issue. It cannot be the issue. The law provides for how a receiver is appointed. We have to find an appropriate a person with the right background and qualifications as spelled out by law. And then we give them a notice of appointment. So that's the mode of appointment. That's very easy. Uh, if if the question is more around should we have resolved these firms? Should we have put them in receivership as the law requires us to? Well, we can have a debate about that, and I'll be very happy to have a debate. Maybe that's for another day. But
Sure.
very, very quickly, let me say that the law recognizes that there's a chain of events that leads to a firm becoming insolvent. And like I said in one of my earlier responses, there are a range of tools available to us to use when early signs of distress begin to appear. So we have the power to remove managers. We have the power to remove a board. We have the power to ask for loans for not for loans to be seized, to new loan creation to cease, or dividends not to be paid. We do have a range of tools, all meant to help to make the situation better. But the law also recognizes that it gets to a point sometimes where all else has failed, and therefore the bank must cease operation. Because if that doesn't happen, the entire system is at risk. Okay, other depositors of other banks begin to get very anxious and begin to run on those other banks, even healthy banks. Before you know it, you have a full-blown systemic crisis on your hands. And so there comes a point where there is no value. All value in the firm is eroded. Equity is gone. The bank is in the red. Nothing, no amount of new money you can put in can solve the problem because there's a deep hole in the balance sheet. And the law says at that point, you cut the losses. You close the bank, you take the license, and appoint a receiver to wind it down. Okay, now we do have a deposit insurance scheme where depositors will be paid something small while the process of realizing value from any remaining assets of the bank will continue. So that's the rationale behind the receivership regime. Were we right in using this regime? Yes. One, the law required us to. Number two, there were no other options. When things have gone on for so long and a bank is distressed for so long and its position has not improved, its condition has not improved, and nothing else seems likely to be done to solve the problem, the only way is to close the bank and resolve it. And so that's not your first choice. That's really the last resort that you would use. And yes, that is what we had, given the fact that these problems, like I said, had festered for so long, and there was really nothing else that could be done than to close these institutions. You did mention how some depositors didn't get their money, and that I can tie that quickly into your second question
Yeah.
about the liabilities of a bank to their depositors. Now,
Yes.
this is a very important issue because the contract is between the depositor and the bank.
Sure.
Okay, and these, like I said at the beginning, the deposits constitute claims on the books of the bank. So the balance sheet has these claims reflected, but there's no money to pay them because, like I said, the assets have gone. The money that you brought in for the bank to keep for you, the bank went to put in a sister company and the money never came back. So there are claims on paper, but there are no assets to match them. That's why the bank is insolvent. So your only claim as a depositor is against the defunct bank. And whether we revoked the license or not, you were not getting your money. Your money was stuck and they were giving you stories. Now, what we do when we close it is to say, well, you cut your losses. Let's appoint a receiver to see if they can find assets that are remaining on the books of the banks that can be realized, whose value can be realized. And then the receiver can proceed to pay down the claims of the bank in the order that is set out under the law. Government steps in to say, while that process is going on, let's find some money to pay off some depositors, because these institutions were insolvent. They didn't have enough assets to pay off their claims, and there aren't enough assets to pay off depositors. And we don't want depositors to go hungry. Government has no obligation whatsoever for this, but it says out of a feeling that we want to provide some relief to Ghanaians, let's dip into taxpayer money to provide some relief to depositors instead of having them wait 3-4 years for the receiver to chase all those people who didn't pay their loans to the banks and all those sister companies who never paid back the money they took. Okay, so the claims of the depositor are against the defunct institution, which will be then in the hands of a receiver. Okay, but government decided, at least on this occasion, that they would step in and provide relief. So government then stood in the place of the depositors and now has a claim against the banks in resolution, the banks that are in receivership, so that in the event that the receivers can get any value out of these remaining assets of the banks, government will be paid back whatever it paid to depositors. So I hope this answers both questions in as simple a way as possible, given that we don't have too much time to get into these technical matters.
Yes, that's absolutely helpful. Yes, so I'll take a few questions. I'll take a question from Mr. Theophilus Teria, and then I'll call Mr. Eric Ansa to also ask a question. I'll start with Mr. Terrier's question. I'll read that. It says, in the wake of COVID-19 pandemic, there is likely to be a positive relationship between customers of banks and SDIs that are unable to pay their debts and toxic assets. What stopgap measures have been put in place to reduce the risk of toxic assets during the COVID-19? I think the main question is, what stopgap measures have been put in place to reduce the risk of toxic assets during the COVID-19 pandemic? Yes.
And who's this addressed to, me or
yes,
Felix?
I'm sure Madam Aduawazi,
Okay.
this falls squarely in your domain.
I wasn't sure.
Sorry about that.
Okay, so what the Bank of Ghana did, even starting as early as March 2020, was to say banks and SDIs, we recognize that you're going to be fairly hit by the pandemic because the real sector is going to be impacted, right? Your customers, whether they're individuals, households, corporate institutions, may have difficulty in continuing to make money, and as a result, may not be able to pay their loans. We feared even more for the SDIs because a lot of their customers are what we call at the bottom of the pyramid, in the informal sector, in the micro, small, and medium-sized sector. And so we, on a proactive basis, we sat down with these institutions and said, we're going to allow you the possibility of restructuring these loans for your customers, because a lot of your customers may not be able to service their loans. So we encourage you strongly to consider providing payment moratoria to your customers, so that if the loan is due to be serviced in June, in March, or in April, tell them you're giving them 3 months of an extension, give them 6 months of an extension. We give them that prompt to say, we encourage you to do that. We actually strongly encourage you to do that. And not just that, then we went ahead to give them what we call policy and regulatory reliefs. We say that we recognize that we have put some regulatory burdens on you in terms of how much capital you must keep at all times in buffers, how much liquidity you must keep. I talked about the fractional reserve banking at the beginning, where I said for every 10 CDs you deposit with a bank, we take 10% of it. We ask them to keep 10% of it in cash, right, in an account, so that they keep that as a reserve. We reduce that by 2 percentage points to 8%, so that instead of them holding 10% cash doing nothing, they could reduce it to 8%, and that they could also reduce the amount of capital they held as a buffer. So we gave them some of these reliefs to allow them then to return some liquidity to the system. If banks no longer have to hold 10% of every deposit they hold in an account in cash, and they can hold only 8%, then they have more liquidity to be able to allow their customers to delay repayment of their loans, for example, right? So we gave them those regulatory reliefs that would encourage them also to ensure that their customers are protected by giving them some relief. And then we said that while you're doing that, because you're going to be extending repayment of loans, we want to be cautious. We don't want you to start going to declare dividends, profits and dividends, when we're all not sure how the pandemic is evolving and how it might hit your books in the end. So we stop them from paying dividends, for example. We're saying, if you do have any profits, keep them in reserve. Don't go and distribute them to shareholders, because it may well be that when all is said and done, your customers may not be able to pay their loans, right? Even after the moratoria you have provided to them. And then banks also, because we also reduced our monetary policy rate by 150 basis points at the end of March, banks also went ahead to reduce their lending rates, even on existing loans. So that also lowered the burden for their customers. So all of these measures contributed to helping to make the possibility that toxic assets could go up a little lower. We do expect that because of low growth rates in the economy, there would be additional bad loans, no doubt. But then without these measures we put in place, it could have been a whole lot worse. Yeah.
Thank you so much. I will ask
just one last point on that. Sure. I also did mention that because we had asked banks to recapitalize earlier on, banks are sitting on adequate levels of capital with which they're able to cushion non-performing loans. So that gives us a little more comfort.
Yeah. Okay. Thank you very much. Mr. Ansah, are you ready? Are you there? We'll take 1 or 2 questions from our audience. Oh, yes, please go ahead.
Okay. I hope you can hear me.
All right. We can. Yeah, please proceed.
Yeah, thanks very much for the discussion. Yes. All right. So I have 2 very quick questions to the panelists. The first question is, I see that there is a quite clear policy of
Look, Mr. Ansah, if you can position yourself well, it appears your network
transactions like arrangements. And so I was saying that in relation to that policy objective, one example I see also is that the Bank of Ghana is creating a good regime for banks to enter into a lot more repo transactions with themselves, for example. But my question is, do we believe we have a good enough regulatory and legal regime to deal with some of the very peculiar financial stability risks which have been noted with the use of those arrangements? So, for instance, do we think we need to impose some new mandatory clearing rules regarding derivatives, or is the regulator's intention to use the existing legal regime we have in that regard? Then my second question has to do with the rules on insolvent trading. So in Act 1015, I noticed that there is a very automatic rule that once a company becomes insolvent, it should cease trading. My question is, do we not want to consider a more flexible arrangement which would look at the peculiarities of the distress being faced by the entity, and the conclusion there will be that the company should be required to stop seizing only if there is no real, say, possibility of turning around from the distress? Do we think this very rigid approach to insolvent trading is optimal in our arrangements? Thank you.
Okay. Thank you, Mr. Ansar. I'm sure Mrs. Aduawazi will take the first, which is on repo transactions, and Mr. Adu will take the second on flexible insolvency regime. So it looks like Mr. Adu is ready. So if you can take the second, and then Mrs. Awazi will take the first. Thank you.
All right. Thank you very much. That is a very good question. In fact, the rules are very severe and strict in cases of insolvent trading. Okay. And that's also in a way to allow for better corporate governance. If you are caught trading while insolvent, you could go to jail for 2 to 5 years, apart from financial sanctions. Okay. Now, this rule is particularly severe, it appears, because we're trying to put some checks and balances into minimizing the abuse of this administration and restructuring provision. Okay. There was a lot of debate as to whether some smart business people, we run down their companies, go to the bank, take some loans, and then quickly move to insolvency, okay, and then go into restructuring. Okay. So yes, this was put in to prevent or mitigate against the occurrence of such a situation happening. Now, of course, when this law was passed, we didn't know there was a COVID lurking around the corner. Okay. With COVID-19, practically all the big economies have had to modify these rules about insolvent trading. Okay. In other words, if you're a director, you realize that your company is in the gray area of insolvency. You are not sure, but you feel it because you can feel some stress battles. And you cannot pay your suppliers when due and honor your demand notices. Then you as the director, to a large extent, you know that you are in the never line of insolvent trading. Okay. Now you need to boldly come out and put in place provisions. Okay. Previously, the argument was that in Ghana, every company is bankrupt or more or less distressed, but nothing happened. In fact, nobody took up this insolvency trading. So a company which is totally in the red, we still create some fictitious papers and then go and take big loans from the bank, and thereafter causing more financial distress and toxic assets for the bank. Okay. So you're right. This is one area possibly we may have to revisit because all the big economies have modified that requirement, okay, for insolvent trading. Okay.
Thank you very much. Thank you very much. Mrs. Sadu Awazi, please, if you can take the question on the first question on creating a regime for repo transactions.
Well, thank you very much. So that's a brilliant question. The Bank of Ghana, first of all, Bank of Ghana is extremely happy to be promoting, the use of repos in the financial system because it really helps banks to manage their liquidity. Repos are really about the fact that the bank has very good quality assets in the form of securities, very typical government securities, whether it's treasury bills or treasury bonds or whatever, but need some immediate liquidity, sometimes overnight. and it can go either to another bank or come to the Bank of Ghana. We do have a repo window to sell the assets to us, to raise liquidity with a promise to pay back, or to purchase it back. So that's why it's called a repurchase agreement, or repo for short. So we're very happy to do this. We've had a repo window for a long time, and it was only last year, was it 2019, I think? Time has flown that last since then. But we did introduce new guidelines for the repo market based on international standards called the GIMRA standard. So we do have a framework in place that guides the trading of repos in Ghana. And I don't know if the questioner is aware of this. This is available on our website, I believe. But otherwise, they can get in touch later. So there is at the underlying any repo transaction is contract law. But in addition to that, we came out with a streamlined set of guidelines that would guide that. He did ask about some kind of a clearing process, central clearing process, and all of that. In very advanced clearing rules. So the GIMRA rules have something to say not only about the trading, but about the clearing and settlement as well. And in very advanced economies where they have very big market, they would have even go to the extent of having a formalized derivatives market or a repo market where you have a central counterparty, one institution that is like an exchange where all of this trading takes place. That says that we will take the risk between the two counterparties. And so if there's a failure on either side, we will settle. We are not there yet, but we believe that the GIMRA rules should do the trick. Don't forget that underlying part of the market infrastructure for repos is the CSD, the Central Securities Depository, which is co-owned by the Bank of Ghana and the Stock Exchange. And that is the central place where all these securities and all transactions on these securities like repos are registered. So the CSD plays the role of the registrar and the clearing agency, if you will, for all of these transactions. And then they have a settlement bank through which these transactions are done. So we're fairly well structured in the repo market, and we will continue to evolve. I think the market will continue to evolve, and if new rules are required, we won't hesitate to put them in place. I hope I've answered that.
Yes.
Well,
Thank you. Yes, thank you so much. I want to ask one more question to Mr. Phyllis Ado on insolvency practitioners. Somebody is asking, and how do I become a member of the insolvency practitioners created under the Act 1015? What are the training and licensing regime for somebody like me, for instance?
Okay, good question. Now, if you've been watching the the daily newspapers, since the beginning of this year, the Office of the Registrar General has been issuing press releases, as to how you can regularize your status as an insolvency practitioner. Now, as of now, there are a lot of insolvency practitioners. This refers broadly to receivers, liquidation, managers, restructuring officers, trustees in bankruptcy, and on and on. Now, essentially, there are three key things. One, you need to be a qualified banker or a chartered accountant or a lawyer. That's the first thing. And you have to be in good standing with your professional association. The second thing is you need to have experience in the area of restructuring and insolvency. Now, this is where GARIA comes in, because GARIA is instructed by the law to assist the Registrar General to evaluate the qualifications of potential insolvency practitioners. The last but not the least is to submit your paperwork. I'm talking about your copies of certificates, your curriculum vitae, and then you should have proof of professional indemnity. You need to have professional indemnity, and you submit all this to the registry of companies. And then the evaluation will take place. If you are not, come April 30th, you haven't regularized your position as an IP, then you are running foul of the law. And like many legal requirements in this law, you stand the risk of going to jail for 2 to 5 years, plus financial sanctions. In other words, we're weeding out all those who appear to dabble in insolvency, in receiverships and all, but without any proper training. I'm an accountant by training. The fact that I'm an accountant doesn't qualify me to be a restructuring person. Same applies to the bankers and the lawyers. Okay, you need to have specific training in this area, and it's rightly so because of the attendant risk with taking over a company and ensuring that you are actually restructuring or you're advising on liquidation. I mean, you are making sound judgment calls. Okay. So that's how you go about it. You can call the office of the registrar of companies and they will send you the paperwork. Okay.
Thank you so much, Mr. Ado. And now I think there are so many questions, but we have just an hour and a half, so we cannot ask all the questions. But fortunately, most of the questions are around the topic that we discussed, and several answers given already have addressed these various questions that we have. So permit me, my employers for today, to skip the questions for now and take closing remarks from our governor and Mr. Ado. So I will start with Madam Elsie Awadzi for her closing final remarks. And if there's anything she wants to tell us, this is the time to do that. And then I'll go to Mr. Ado thereafter. Thank you.
Thank you very much. So let me just, in closing, thank you again, Dina Bochi and your team at UPSA, as well as Ernest, who's been a fantastic moderator, and Felix, my co-panelist, who I have a lot of respect for. We go back a long way, and we've worked together in various capacities. Let me just say that as regulators of the banking sector, the Bank of Ghana understands the tremendous responsibility that is placed upon it, with the banking sector being a key driver of economic growth and development in our country. There is a whole lot that goes into regulating and supervising banks to promote their stability and by that, the stability of the entire financial system. There's a lot of components to this. The current management of the Bank of Ghana, starting from August 2017, saw the need to clean up the banking sector. I can't tell you how often I meet someone, a total stranger, who tells me we all knew what was wrong in the banking sector. We all knew. It wasn't a surprise to us. Something was wrong, and it was very wrong. And somebody had to do this. We had a new law that had been passed in 2016, based on international best practices, from the learnings and the lessons learned from the global financial crisis as to how to manage banking sector crisis. And we have applied that law. I think the benefits of having closed 420 insolvent institutions is clear to everyone. Even in the midst of a crisis, we have a banking sector fairly resilient and helping not only to keep the economy afloat, but it's going to be a key driver in post-COVID economic recovery. And so we do understand how important it is for us to continue being a vigilant supervisor. And like I said, banks are licensed to take deposits from you and I, and they will continue to do it. We expect them to do it. And banks cannot keep the deposits they take under a pillow, like you and I might be tempted to do. We go to the bank because we expect the bank to use our deposits to make money for us and for themselves so they can stay in business. It is absolutely important that the banks, under the control of their own shareholders, their boards of directors, and their key management personnel, deploy these assets in ways that allow them to stay resilient and also to be able to return depositors' funds to them as and when they want their money. And so this is the direction of our supervisory work now, making sure there's sufficiently strong rules in place to promote good corporate governance, strong risk management, and ensure that banks continue to have sufficient capital. And when I say banks, I mean SDIs as well. Banks and SDIs continue to have sufficient capital to absorb losses that they might make when they deploy these assets. And so that's the work we continue to do. And this conversation, I think, I do hope has opened the eyes of participants to understand all the complexities behind the operation of banks and how we regulate them. But I do hope we get another opportunity soon to continue the discussion. Thank you very much.
Thank you so much, Madam Governor. You've been in.
Yeah. Ernest, can I come in now? Let me thank you also for inviting me on this panel. I couldn't have been team up with
Yes.
a more.
Yes, you have the floor, please.
Yes, okay. Well, let me thank you for also inviting me to be on this panel. I couldn't have teamed up with a very competent, focused governor who knows his stuff. So thank you. The current regulations and directives we have in place, from the Banking Act all the way to CIRA at 1015, have sufficient regulatory framework. What we need to do now is train people, build capacity so that practitioners will be able to understand and carry out and assist companies who are distressed. Okay. I hope that the 255 members of GARIA will lead the charge in assisting companies with capacity building on these restructuring and insolvency issues. Okay. Let me mention that one of the things Bank of Ghana had done, which I guess is not mentioned in dispatches, is the fact that the bank gave Ghana government a 10 billion CD bond relief. Okay. Now, in the bigger scheme of things, all this went in to help with the COVID relief. Okay. So in addition to the direct bank, central bank to bank issues, there was also the broader picture where Bank of Ghana did assist with the global, the macro economies issues with regard to the COVID relief. It's been a useful interaction, and I'll be looking forward to another opportunity to participate in further discussions. But as you can see, you really needed Madam Adoawazi for this whole panel discussion, because she has all the answers. Okay, but I'm glad I was invited to join her, and it's been a good learning and education experience. Thank you once again. By the way, Madam Adoawazi is a member of GARIA, and she is our editor at large for the GARIA publication for insolvency and restructuring. Okay. So we'll be seeing more of dispatches on the subject. Okay. All right, thank you very much. Yeah.
Thank you, Mr. Ado. The interesting thing is that both panelists have Ados in their names. So we have Madam Ado Awazi and Mr. Phyllis Awazi, and you can be sure, you can agree with me that Ado, yes, Mr. Phyllis Ado, thank you. Yes, so maybe it's a name that is the go-for name now, because you can agree with me that they have discharged themselves excellently, and it's been so wonderful having you. Before we go to a very important segment of our program, we'll take a message from Upsa, who are our sponsors for the program. So please, we'll take a short message, just a few comments, and then we'll come back. So please don't go away, be with us. Thank you.
Tap into the convenience of Upsa contactless cards, another innovation that's turning banking on its head. Now, you can make fast, easy, and safe contactless payments for everyday items. That's Africanacity. That's Upsa.
Welcome back, our viewers and participants. We'll now take our closing remarks from the head of department for UPSA Public Law at the UPSA Law School. She's in the person of Francisca Kusi Apia. In fact, Dr. Francisca Kusi Apia. Please forgive me for omitting the doctor. Emphasis on the doctor. You're welcome, Doc.
Thank you very much, Ernest. Yes, we all agree this has been an interesting discussion. In fact, we are all walking away as equity experts in toxic assets and liabilities that banks owe to their customers when they eventually become insolvent. On behalf of the UPSA Law School, I wish to express our profound gratitude to Mrs. Elsie Adu-Awuzie, the Deputy Governor, for taking time out of a busy schedule to join us. The same goes for Mr. Felix Ado, the President of GARIA. We are most grateful for joining us. And to Ernest, thank you so much for doing a great job for steering the discussion and making it very interesting. And to our distinguished guests and to our audience, thank you so much for joining us. And indeed, this program couldn't have also taken place without our main sponsor, Upsa Ghana, a leading bank in Ghana. We are most grateful to you for investing in us so that some of us could all learn about wonderful projects going on in the banking sector and also contribute to wonderful reforms in our country, Ghana. And to the wonderful team that put together this great program led by Ms. Gertrude Ama. Thank you so much for doing that. And we hope you all join us in 3 months' time for the next banking quarterly roundtable discussion. Thank you and have a lovely day.
Thank you.
Thank you very much, Doc. And I think I have nothing else to say than to say thank you to everyone for a wonderful session of this nature. I've enjoyed it, and I believe everyone else did. So we'll see each other during the next quarter's edition. Have a blessed afternoon. Bye-bye.
Bye.
Tap into the convenience of Upsa contactless cards, another innovation that's turning banking on its head. Now, you can make fast, easy, and safe contactless payments for everyday items. That's Africanacity.
Hello,
That's
Don.
Upsa.
Can you hear me?
Charlie?
Yes.
Doc?
Yes.
John, can we get our attendees off so that just the panelists